afternoon, everyone, and welcome to Stock Market Today. Ali Corman, Ed Carson here with a breakdown of the action in today's session and this week. And Ed, we capped off the week on a pretty bearish note.
Yeah, let's break down the market like the market broke down a little bit. Not very good action. Yeah, one of the big reasons today among a lot of the geopolitical news was AMD really sold off hard. There were a few bright spots, Regeneron and Oneok, a couple of stocks that are moved higher, at least through most of the day.
All right, well, we'll check in on those, but first let's analyze the action in the major indexes. The NASDAQ taking a big hit on Friday, finishing the day down 2.8%. We also had the S&P 500 down 1.9%, the Dow down 1.4%, the Russell 2000 down 1%. So this is disappointing. We are early in a market rally, and so to see a day like today definitely adds to the nervousness that I think we've been cautious, but this definitely is not the direction we want to be heading.
Yeah, and this is why we were cautious. Absolutely right. Just going through the week, it started off okay. I mean, well, certainly on Tuesday and Wednesday, we had pretty solid gains. On Wednesday, we got near the top of this sort of range. We were sort of in this range from the prior week. And so it was looking pretty good. You know, the NASDAQ and S&P were at the top. The Dow and Russell were actually above those levels. So that was nice and that was fine. But then we had that hot inflation report, and then and so that sent treasury yields surging. On Friday, fears that the Russia-Ukraine conflict could turn hot really sent things tumbling today. So, that triggered it. There's that brown line there that it looks like the NASDAQ is falling on. That's a moving average. It's actually of the relative strength line. So that's not relevant. But I just want to make it clear so people aren't thinking it's finding support there.
Well, let's see. We can get rid of that right here.
Gotcha. That's a new feature. So just
there we go.
And okay, there we go. So we undercut the lows of that recent consolidation, but we also on the left on the January 31st day, that was the follow through day when the rally was we confirmed the uptrend. Something that's a very bearish sign is if you close below the low of the follow through day. Now, we actually closed a sliver above the low, but not great action. And the reason why we care about it doesn't end the rally, but if you close below the low of the follow through day, it's a very strong signal that the rally will ultimately fail, that it will ultimately go below the lows. And as you can see, that'd be a long way to go. Not a long way to go, but a decent way to go. And you can imagine how the stocks in your portfolio might react if we got to those lows and beyond. So not a very good sign. I mean, we technically didn't close at that below that, but not good here.
Yeah, so we undercut that January 31st low intraday, and that low being 13,767.71. We closed today at 13,791.15, so just a little bit above it. So that's definitely going to be the level to watch. We'll have to see if this bearish momentum heads into early next week. But as you said, Ed, I think just to reiterate, closing below that follow-through day is a sign that the rally is likely to not work. But I would say this hasn't been a rally that we've been super excited about to begin with, even in those early stages, because usually at the beginning of a new market rally, you're at least starting to see a lot of setups or stocks forming bases, but that issue of merchandise has been questionable so far in the rally. We have seen some areas work, but not like what we're used to seeing.
No, and especially in the areas we like to see in those growth names. And I think one reason is that look at the chart. I mean, if for the market to come roaring back, it would be such a big V shape. To be honest, having a failed follow through day or at least a very choppy action for a while wouldn't be the worst thing, because then you'd have maybe stocks that could have relative strength, sort of pick up and form bases, because it's hard to do that after that sharp tumble like that to come right back up.
Yeah, and I think this is something for investors to have to unfortunately refamiliarize themselves with. It's been a while since we've had a couple of failed follow through days. I'm reminded of Q4 2018. There were 2 failed follow through day attempts, as we've been talking about with this most recent follow through day. That hey, that's something that could potentially be in the cards. And again, we can't predict. We can only interpret what we're seeing right here, right now. But it'll be interesting to see how the action plays out into next week. And let's also check in on the S&P 500 here, which closed below its 200-day line here today, Ed.
Yeah, really decisively through there. And just a couple of days ago, it was on the verge of getting above its 50-day line. So, I mean, I suppose we could go the other way and quickly rebound, but right now the action is not looking good. This one, I think, closed 4 points above the low of its follow through day. So basically 0.1% or so, just barely doing that. So not a good sign there either.
And let's take a look at the Dow 0 DJIA in MarketSmith. Just got above its 50-day line earlier in the week, now below the 200-day line and that 35,000 level. And the Russell 2000, which we saw a follow through day on Wednesday, I believe, now turning back the other direction.
Yeah, the only positive thing you could say is that the Russell at least was up for the week. So I guess to a certain extent, market breadth, of which I'm sure was terrible in the last couple of days, but the market breadth was maybe a little better than the indexes would show, which is not what we've seen over the past year. I mean, the past year, the major indexes have hidden the weakness in the market. So yeah, a little bit of a gain, but nothing really special either.
Yeah, nothing to celebrate. And let's stay on the weekly to take a look at the 10-year Treasury yield to see how that's trending.
Now, this got up to about 2.06 today and came way off those highs as the market sold off. So but it's not like the pressure is really off. One, it's still pretty close to those 30-month highs. And the other thing is, if say Ukraine tensions fade, like if that backs off and comes like, one would imagine that the bond yield would rebound very quickly. I mean, the Fed is going to raise rates, so that's still a concern. I mean, with the market coming down, we knew that there were Russia tensions, we knew that there were bond and Fed rate hike, but now the market is taking even more seriously. I mean, obviously, bond yields have been pressuring the market for a few months, but it looked for a while like we were holding up, and now we're not. Now those forces are really starting to hit the market. We'll see if that continues, but definitely not a good way to close the week.
No, not a good way to close the week at all. And as you mentioned at the beginning, AMD dampening the picture here, a pretty big plunge for the stock on Friday. It was about to get above its 50-day line, or at least, in striking distance. But instead of retaking that level, we saw some resistance and a pretty sharp decline on Friday, with the stock down about 10% in heavy volume.
Yeah, there might be some of this, might be the fact that they're closing the Xilinx deal, but everybody knew that was going to happen a few weeks ago. So, it's hard to really get to blame that on that, even though the news technically broke a couple of days ago. I don't know why it sold off so much, but man, I mean, it was really ugly. On February 2nd, I believe, it gapped up on earnings, so it had really strong earnings. It didn't close especially well, but it was a nice gap up, and it continued rallying. But now we've wiped all of that out, and I think that's when the market is weak. You can have situations where the stock gaps up on strong news, especially earnings, and maybe it does well that day, but then it might soon struggle. It's if the tide is still that way, can you really withstand it? And so. This was unfortunate. The volume, aside from that earnings day, was very heavy volume today. Not a good sign, because if the chips are weak, it's hard for growth to show any kind of strength.
Yeah, I mean, when you see stocks that take such big hits as AMD did in the correction, it would be very rare to see it just race straight right back up to highs. Sometimes these take quite a while to play out. And if it can hold above the 200-day line, that would be great. But it could very well test that 100 level again. we'll have to see.
We don't know. And there's obviously a lot of weakness now in the chips, which just a few days ago, we're starting to show a little bit of strength because again, these weren't as richly valued as some of the triple digit software names that we've been talking about. The SMH semiconductor index looks a lot like AMD, not exactly, but it was coming up to its 50-day line. Now it's plunging through its 200-day. It's not undercutting the lows of recent lows, but not good action here. And again, you could see how it was holding up, just like AMD was a few months in December, and then it really cracked in January.
And let's check in on NVIDIA as well. NVDA taking a hit of about 7% on Friday, and it has yet to report its quarterly results. We have that coming up next week.
Yeah, that'll be a big deal. But obviously, yeah, that lot of ugly action. I'm sure it's not just in tech, but just in general. It was a really unpleasant day for the market.
Well, there are some bright spots. So let's take a look at Regeneron, REGN, up over 3%, some above average volume behind the move. And it is arguably presenting an early entry here if investors do want to try to maybe nibble on a small position. But we have overall conditions and that uncertainty in the market right now.
Yeah, this looked more actionable in the morning just because the market was okay. It's okay. You could sort of see it. But now with the market sort of really seeming to look weak, it'd be, maybe this worked. This held up well today. There was some good clinical trial data. So again, like the earnings news, maybe it'll just fall. If the market sells off, it's hard to see Regeneron or any other stock, lasting. But a few good things. One, you made a good point during IBD Live this morning and talking about how the relative strength line has been pretty weak for this stock since 2015. It's had trouble sustaining that. But, on the upside, I guess you could say, yeah, and even further than that, so it's like it is sort of at the best levels, in several. It looks like it's getting toward a 52-week high now for the RS line, depending on what, if you look on a weekly maybe or something. But so there's that. It's perking up a little bit. There's different things on it. Had a great 2021 in terms of earnings, a huge growth there. The earnings are supposed to fall quite a bit, in part because the COVID antibody treatment. COVID is going away and it doesn't work on Omicron. So it's basically that's the way. But from another perspective, and I guess you could sort of think about this, how we've looked at it with the shippers, the earnings are still a lot higher than they were in 2020. They're supposed to be at least. So, I mean, if you didn't fully price in, I don't know, but when you factor that in and the fact that it's got a PE ratio of 8, we're not talking about betting when we've looked at 200 PE stocks a lot last year, this is reasonable there. And that's the kind of environment we're in.
And a good point from you is the tight closes that Regeneron has had over the last couple of weeks before making this compelling move this week. So it's not a long-term leader. Not every stock can be, but it has been known to make moves in the past. So maybe this can hold up and offer a quick gain for investors who might be interested in it.
That's right. But yeah, I do think I'm less bullish on it than I was in the morning because of the market conditions. I think that you have to be very careful about that.
Yeah, that's so important. There's a reason why we are paying so much attention to the market action, because that definitely impacts the price action that we see on the individual stock level. Well, one sector that's been quite a standout so far this year is the oil and gas area. So here's a look at Oneok. Yes, it's not Oneok. It is Oneok as in Oklahoma, based in Tulsa. So OKE here, up about 2.6% this week. I had a trend line drawn from IBD Live, and it looks like it cleared that level.
Yeah, it was nice action in there. And this is a natural gas play, so it didn't have that huge surge because oil prices really surged. So a lot of oil names, but a lot of the oil names are either extended or sort of messy. This one looks a little better. It has a, as you were saying, like there's the official buy point of 86, 88, right at the top of the base. But really, I think, you're doing a trend line across, from the top or, just along maybe the 63 level, across there. It's still in range from that. And it's not too far above the 50-day line, or at least not radically so. The RS line is hitting a new high. So there's a lot of positives from there. While it's not directly correlated, if you could see natural gas prices getting a bit of support with all the European natural gas prices being sky high, encouraging LNG exports, which this isn't particularly directly in there, but it just means that there's more underlying demand beyond just the US. We can ship out stuff at a pretty nice premium to other countries.
So with all of the other stocks moving in the sector, do you think that there's a little bit of risk with trying to get into one now after we've seen a 5-week group move, or is this the kind of thing that can have more legs?
That was one reason I wanted to look at I wanted to look at an energy stock. I felt crazy if I didn't look at an energy stock today. But I was like some of the oil stocks, it's like those have had a huge run. Natural gas, I don't know if it's had as much of a run. And so I think that I don't think there's as many of the natural gas plays have surged. Everybody should do your research, and you should know there's a lot of differences between these energy companies. You can't just say, oh, it's an energy company, I'm buying it. But I think that's a really good point on the oil stocks. I'm not sure on the natural gas. I feel like there might be more room, and it's not as much of a laggard in that regard, because there's a lot of stocks that have relative strength lines near highs, but are sort of laggards in the energy sector.
Yeah. And I just pulled up XLE here briefly. And I mean, what a great move that this sector has had since January 3rd. I remember drawing this very trend line that morning of the 3rd on IBD Live. Too bad I didn't buy XLE right there, Ed.
I know. And who would have thought that? Oh, yeah, of course, Chevron and Exxon are going to be the big ones. It's not these high flying shale companies. It's sort of these lumbering giants. They're just powering, because that's XLE. That's, I think, 40% is Chevron and Exxon. So, wow, look at that relative strength line. That's just incredible.
Yeah, very impressive. Okay, Ed. Well, with all that said, we got to kind of, digest that and figure out our game plan for the week ahead. It seems like important to freshen up that watch list, but what about existing holdings? It seems like now might be a time to assess whether or not they're worth still holding on in your portfolio when we're seeing the market looking a little shaky.
I think that's a very good point. I think you should be thinking about reducing exposure, either because the stock itself doesn't look good, either it's giving up gains or it's becoming a loser, or you're just saying, I don't want this exposure. It depends on some people. If you got aggressive, if you're the type to say, I want to jump in, well, you have to be able to jump out. You have to jump out pretty quickly too. So definitely if you have a lot of exposure, and you may just want to move out. I mean, like cash has been a pretty good position. Yeah, I mean, energy, fertilizer. Yeah, there's places to work, but most stocks have been falling, especially the growth names. And look, I think until we get above, say, the highs, those recent highs that we had a few, like a week or two ago, until we get above that, I don't think you'd want to be playing this market, making new buys, really, except in rare, specific niche circumstances. It's just not conducive. The odds are not in your favor.
Yeah, protect that capital and your mental capital too. Let the market prove itself to you. Stay patient and flexible. All right. So some great thoughts there, Ed. Thank you so much to cap off the week. And as we head into the weekend, thanks so much, everyone, for watching. And we'll see you right back here on Monday.